Profitability and profit, two terms that often get tossed around in business discussions, are critical to understanding a company's financial health. They may sound similar, but they represent different aspects of a business's performance. So let's break this down in a way that's engaging, relatable, and informative. First off, let's clarify what profit means. Profit is pretty straightforward. It's the leftover money after a company has paid all its expenses. Imagine you run a lemonade stand. You sell lemonade for $1 per cup and sell 100 cups in a day. That's $100 in revenue. Now, if your costs, like lemons, sugar, water, and cups, add up to $60, then your profit for the day is $40. Simple enough, right? Profit is that sweet reward for your hard work, the money you can use to reinvest in your stand, pay yourself, or maybe even treat yourself to something nice. Now, profitability is where things get a bit more nuanced. Profitability is about the ability of a business to generate profit relative to its revenue. It's not just about how much money you make, it's about how efficiently you can turn your sales into profit. Using our lemonade stand example, if you managed to sell those 100 cups for $100, but your costs were $90 instead of $60, your profit would drop to $10. Your profit margin, the percentage of revenue that becomes profit, would also decrease. Profitability, therefore, tells you how well you're managing your costs in relation to your sales. Now, let's dive deeper into calculating profit. It's essential for any business owner or aspiring entrepreneur to know how to calculate profit. First, you need to know your revenue, which is the total income from sales. Then, you subtract your costs of goods sold. Those are the direct costs of producing your product, like the lemons and sugar in our lemonade example. What you're left with is your gross profit. From there, you subtract your operating expenses, things like rent for your stand, marketing costs, and salaries. The formula looks like this: profit equals total revenue, total expenses. Easy enough, right? But here's the kicker: profit can be affected by one-time events. Maybe you had a particularly good day at the stand, or perhaps a storm ruined your sales for a week. Profit can fluctuate based on these external factors, which is why profitability is often a more reliable indicator of a business's long-term health. So how do we measure profitability? There are several key ratios that can help you understand where you stand. The first is the profit margin ratio, which tells you how much profit you make for every dollar of sales. You calculate it by dividing your net income by total revenue and multiplying by 100 to get a percentage. If your profit margin ratio is high, that's a good sign. You're making more money from each sale. Next up is the gross margin ratio. This one looks at how much money you keep after accounting for the cost of goods sold. It's calculated by dividing gross profit by total revenue. A high gross margin means you're running an efficient operation, which is always a plus. Then there's the return on investment ratio, or ROI. This is crucial for investors. It tells you how effectively you're using your resources to generate profit. The formula is simple: ROI equals X100. A high ROI indicates that your investments are generating good returns, which is what every business owner wants to see. Now, let's talk about the differences between profitability and profit. Profitability is a measure of efficiency and sustainability. It tells you how well you're managing your resources over time. Profit, on the other hand, is an absolute figure. It tells you how much money you have left after expenses in a specific period. A company could have high profits one quarter and low profits the next, but if it maintains a consistent profitability ratio, it's likely on solid ground. Another key difference is that profitability is a relative metric. It allows you to compare your performance against competitors. If your profit margin is significantly higher than that of your competitors, it indicates that you're doing something right. Profit, however, is an absolute measure. It tells you how much money you have, period. Both profitability and profit require a clear understanding of costs and pricing. If you don't know how much it costs to produce your product, how can you set a price that allows for profit? This is where many businesses stumble. They might have a great product, but fail to account for all the costs involved in bringing it to market. Both concepts also require efficient resource use. If you want to improve profitability, you need to streamline your operations and make smart decisions about resource allocation. It's about working smarter, not just harder. Now, why do profitability and profit matter? First, they're essential for survival. Without profitability, a business can't sustain itself in the long run. Profit allows for growth, reinvestment, and the ability to weather economic storms. A profitable company can pay its employees, invest in new projects, and ultimately thrive. But here's the thing: profitability often matters more than profit. Why? Because profitability is a measure of efficiency. A business can generate revenue but do so inefficiently. If you're not profitable, you're likely to run into trouble down the road. Profitability is about sustainability. It's about ensuring that your business can continue to operate and grow in the long term. Investors also care deeply about profitability. It's a key indicator of financial health. A company that demonstrates consistent profitability is more likely to attract investment. Shareholder value is tied to profitability. If a company can't generate sustainable profits, its stock price will reflect that. So, how can businesses improve their profitability without sacrificing quality? It all starts with a close examination of costs. By keeping a tight grip on expenses, businesses can find ways to save money and improve margins. Reviewing pricing is also crucial. Ensuring that prices reflect the value of the product while remaining competitive can make a significant difference. Offering discounts and promotions wisely can help attract customers without eroding profit margins. Focusing on efficiency is another key area. Streamlining operations and investing in technology can lead to significant cost savings. And let's not forget about quality. Constantly striving to improve quality can lead to higher customer satisfaction and loyalty, ultimately driving sales and profitability. In conclusion, understanding the difference between profitability and profit is essential for any business owner. Both are critical measures of success, but they serve different purposes. Profit tells you how much money you have left after expenses, while profitability measures how efficiently you're generating that profit. By focusing on both, businesses can ensure their long-term health and success. So, whether you're running a lemonade stand or a multinational corporation, keep these concepts in mind as you navigate the world of business. Your future self will thank you